GC. So then talk to me about this scenario that we're going to compare.
All right. So I said, well, listen, there's 84% of Americans that earn over $100,000 out there are investing in the stock market. Y'all got a lot of money in the stock market. I mean, and it's been a nice run in the stock market, for the last, call it, 10 years, really. So at least that's the impression, right? That the stock market has had a really great run over the last 10 years. Would you know that the average 60-40 portfolio, according to Vanguard, has earned a 6% return year over year for the last 10 years?
That blew me away when you said it.
It's crazy, right?
Yeah.
6%. Yeah. So yeah. Oh, you guys got money in the stock market. And when you think about coming to real estate, a common theme is like, oh, geez, how much money do I have in my bank account that I got to go put into this rental property? No, think about how much money you have in the stock market, in your retirement accounts, right? All of that money could and should be analyzed and maybe move some of that money over. So, I'm not naive to think we all have 300 grand sitting around in our bank account, but I'm also not naive to think that some of you don't have 300 grand in the stock market and are way overly dependent on it. So maybe this message is more for you guys. So you got 300 grand. If you keep that in the stock market and stocks and bonds in a portfolio of 60% stocks and 40% bonds, which is the typical portfolio, this is how it will shake out over the next 20 years, according to Vanguard. Your down payment percentage is 0 because you don't have the benefit of leverage in traditionally buying stocks and bonds. But over the next 20 years, you're going to earn over 860 grand from that investment. That'll bring your total portfolio value up to a little bit over $1.1 million. And you're going to earn a 7% return on your money year over year over year for the next 20 years. And that's how those numbers shake out. So what do you think when you see those numbers?
I mean, that sounds like what we're accustomed to hearing, right? Like I think the idea that I got to save 300K in 20 years, it turns into like 1.1 million. It's attractive. It's cool. Like, it sounds awesome.
It's cool.
It's like the magic of compounding interest, right? That Buffett talks about, the eighth wonder of the world.
Yeah.
Yeah. It's awesome.
The stock market works.
Yeah.
That's why your parents told you it was smart to invest in the stock market, and their parents told them it was smart to invest in the stock market. And, this isn't a show talking about how the stock market is terrible. This is a show to show you that simply real estate also deserves a seat at the table. Mm-hmm. And that the simple fact is that Americans are way overly dependent on the stock market. But at the end of the day, earning 7% on your money year over year is fantastic if that is a part of your overall plan, maybe not your entire plan. So I wanted to show you, open up your eyes to what it would look like to take that same amount of money and put it into a Jacksonville real estate portfolio.
All right, GC. So let's look at a $300,000 portfolio in real estate.
Yeah. So you have that $300,000. It was in the stock market before in the form of retirement accounts and brokerage accounts and whatnot. And maybe that was 100% of your investable capital out there that you're planning for retirement. And you chunk out 300 grand of that in this example, and you put it into a Jacksonville real estate portfolio. But now you have this beautiful thing that we can start to teach you about and teach you how to leverage, how to use other people's money. And so all of that comes down to, what percentage down are you putting down for your portfolio? And we'll run a couple scenarios with different percentages. But the fact that you have the opportunity to leverage, to use other people's money, to get a loan for real estate is an asset in itself that the stock market doesn't generally allow you to do. I will tell you that it does allow you to invest in the stock market with leverage. It's called buying on margin. I looked up rates for what it actually costs to buy on margin in today's environment. Those who invest on margin, which is in essence taking out a loan to buy stocks, they're paying 10 to 15% interest to be able to do that. And it's not that unheard of, by the way. In my deep dive of all these numbers this weekend, I uncovered that about 21 million Americans actually borrow to buy stocks. They buy on margin and pay 10 to 15%. And there's a whole lot of other things that go along with buying on margin that are tough to deal with as an investor. So anyways, Jacksonville real estate portfolio, let's say you put 35% down for this portfolio. Somewhere around there is going to be break-even cash flow. So now I'm kind of like right there with what the stock market generally does. Break-even cash flow is kind of where you're at. That same $300,000 in a Jacksonville real estate portfolio is estimated to have over $1.4 million in returns, and it's estimated to be worth $1.7 million in change at the 20-year mark. Your money would be gaining at a rate of 9.7% returns each and every year over the next 20 years. And we just turned an additional about $600,000 in profit for this investor if they made that decision.
I would not have thought that 2.7% difference is more than $500,000 over 20 years. That's a pretty big number.
You're working with big numbers here.
Yeah.
You're working with big numbers, and small adjustments to return on investment have a significant impact. That's why you need to look at return on investment, but you also need to look at total growth, total value here to make the best decision for yourself. Don't just buy into the thought that 7% here versus 8% here is negligible, or 7% versus 10% is negligible. I mean, guys, just in this portfolio here, right, we're talking about a $600,000 difference.
Yeah.
I mean, depending on what the stock market does in 20 years, that might be the difference between you having to take a job to support yourself or to pay for medical bills that are happening later on versus not.
Yeah.
You know, that's what I really, really believe. That's why I'm so passionate about this asset class. This asset class wins.
Seeing it like this makes a lot more sense to me. The stuff that I normally see that I can't really explain, right? Like there's this podcast that I love called My First Million.
Mm-hmm.
And they were talking about, they're like, oh yeah, man, as an investor, there had some like big, sharp, rich guy on there. He's like, yeah, as an investor, if you give me like 10%, I'll take that all day, every day, if it's a safe investment. And I'm like, okay. Like I heard him say that. And in my head, I'm like, well, 7 to 10%, that's not that big a deal. Cause we've shown these like 14% returns when I first was like green and I got used to those numbers. So I was like so unimpressed by this idea of 10%. But like, if you look at this and you think about this idea that in 20 years, the difference between 7 and not even 10% is more than $500,000. Now you understand why folks that are looking for an edge over just the regular stock investment of Vanguard go into these alternative assets and like take extra hits on risk or whatever to get an extra 1, 2, 3%. And yet what we're talking about is a super safe asset, right? This like workforce housing, passively managed in a growing city market that is going to continue to have increased demand for like the lack of supply that's there. And it's 20 years, right? So I'm like, I'm 42. Everybody that I talk to is like, this all makes sense. I just wish I would have started earlier.
Mm-hmm.
For me, my head goes to like, okay, yeah, sure. If I'm 20, 30, 40, cool. But like, if I'm 50, I want that to happen too, right? Like if I'm, and I don't know how many 20-year-olds have 300K in an investment, but if you're 50, 60 and you have 600 grand, 800 grand in the stock market because you've been dutifully saving, to take 300K off to make an extra $500,000 by the time you're 70, by the time that you're 80, you're going to need that money. Like I don't, unless you're planning to die at 78, which I don't think any of us are really doing in today's environment. Like, why wouldn't you want to get that extra 2.7% by doing this, which seems just like mathematically so feasible?
I love the way you think. I'm trying to connect with more folks that think the way you do, and to influence more folks to think that way. I think for most people, it's just as simple as this. They think real estate's hard.
Yeah.
They think real estate's hard.
Yeah.
If we could solve the ease problem,
then
we could make this something that people would think more the way that you do, because it's been solved for you. It's easy for you now. You've lived it.
I want to knock out this last case that you have here as well.
Sure. So when you come to my team and we sit down and we build a customized portfolio for you. So it may be 35% down. It may be 25% down. It could even be 40 or 50% down. It could be a combination of cash purchases and finance purchases. It's not one size fits all. So if anybody would like to know how this actually will play out for you, I would highly encourage you to go to chatwithjwb.com and set up a time to speak with my team. And through those conversations, we'll say, okay, what are your goals? What are your resources? Maybe 35% down is not that right figure for you, because if we actually put a lower percentage down, what you're going to see is more growth. Now, you won't get as much cash flow. In fact, you may even go cash flow negative at 25% down, right? And we can talk about when that might make sense. But at the end of the day, if you put less down, your returns are going to be higher when you factor in historical assumptions on Jacksonville real estate. And it's not by a small number, right? $2.1 million is what we would expect that $300,000 initial investment to be worth after 20 years here in Jacksonville real estate, with an estimated return on investment up to that 10% number that they love so much on My First Millions. And now comparing that to stocks and bonds, that's $1 million more that we have been able to drive and generate for you as a client because you made the right decision 20 years ago to take some of your chips off the table for the stock market and put it into a different asset class. So you get diversification, a more consistent asset class. And oh, by the way, should deliver significantly higher growth.
Man, so at 25%, it's an extra $1 million.
$1 million.
Yeah.
We're not talking about small numbers here.
Yeah. These are not small numbers. Okay. So what I'm taking from this, I'm taking this idea that if I have money that I'm going to need in 20 years and I have a pile of cash right now that I have in the market, I want to be thinking about how much of the stuff I have in the market do I want to keep in the market and how much do I want to diversify, right? Like we talk about the 60-40 portfolio as you are 60% in stocks, 40% in bonds.
Mm-hmm.
Why wouldn't I want to be like, okay, cool. Well, why don't I go 60% stocks, 40% real estate or 50% real estate or whatever? If it's such a bigger revenue, wealth creator, more consistent revenue generator in the time that you need the cash flow, it's that idea, right? So if I am in my 50s or 60s and I have $600,000, $800,000, $900,000 that I have with a financial advisor in a stock portfolio, have this conversation of like, could I, why wouldn't I want to take these like $300K, put it in the stock market? And if that is something that's curious, go on a chat with jwb.com to like setting up a call and have them work it out with all the other minutia that
100%.
comes with it, what the experience looks like, what all these different is kind of the takeaway here.